Have you ever felt the weight of uncertainty? The quiet dread that settles in when the world feels like it's spinning just a little too fast. We've all been there. This week, the market didn't just move, it breathed again. A powerful surge after weeks of tension, a moment that demanded attention. But don't mistake a rally for a resolution. It's a story still unfolding, a landscape peppered with both promise and peril. I'm Alyssa Coram, and I'm joined today by my colleague Mike Webster, or Webby, as many of you know. Webby, it's been a week, hasn't it? A genuine shift in the current. It has been. It has felt different. A change in the air. What a difference a week can make. We're going to unpack it all: the index movements, historical patterns, what's happening beneath the surface. We'll even share some stocks to watch, and of course, our song of the week. But before we dive into the numbers, let's remember something crucial. The market isn't a machine. It's a reflection of human emotion, fear, and hope all tangled together. And right now, hope is whispering a little louder. Let's start with the headline numbers. The Nasdaq soared another 1.3% today, leading the charge. The S&P 500 climbed nearly 0.75%, breaching that significant 5,500 level. The Dow was modestly positive, but honestly, we don't spend much time focusing on the Dow, do we, Webby? Not particularly. It's a bit slower paced. And looking at the week as a whole, truly impressive. The Nasdaq jumped 6.7%. The S&P 500 gained 4.6%. A sea of green on the screens. But a green sea can hide treacherous currents. It's tempting to simply celebrate the gains, to declare the worst over. But that's where historical context becomes vital. To truly understand where we are, we need to look back. Forget the headlines, the political noise, the endless stream of news. What is the market telling us? We saw what felt like a capitulation bottom a few weeks ago, a moment of profound selling. Then came the news spike, the dramatic move. That's normal, especially in sharp bear markets. We've seen it in 2000, in 2008, even during the COVID crash. It's a consequence of short covering, of those forced to buy back shares they bet against. It's a powerful, often chaotic force. But what happens after that initial surge is what really matters. Can things settle? Can the swings become smaller, more contained? Can we start to see days closing near their highs, demonstrating sustained strength? We've begun to see those signs, more orderly accumulation, less of the frantic, knee-jerk reactions. That's a good sign. A healthy sign. But it doesn't mean we're out of the woods yet. Because looming over us are those declining 50-day and 200-day moving averages. They're like shadows, warning us of potential resistance. Getting above the 50-day is a challenge, but breaking through the 200-day, that's a major accomplishment. A true test of strength. And when we get closer, we need to be cautious. These levels can be magnets, attracting price action, but also creating the potential for whipsaws. Right now, it feels like the market is drawn to the 50-day line. It's the focal point. Let's see if it can get there. We had that marked low, that hurdle we cleared. Getting the low above the 21-day moving average was a significant signal. And even more powerful when combined with a closing price above that same level. But we must remain vigilant. Bear markets are notorious for offering false dawns, for rallies that ultimately fizzle, only to be followed by new lows. This is a time to trade with caution, with one foot firmly planted on the sidelines. So we have encouraging progress, but also valid concerns. Let's look at the S&P 500. Back above 5,500, breaking above that previous high. But the 50-day line remains a key battleground. The question isn't just can we get there, but what happens when we do. Understanding history is crucial because it offers a roadmap, not a guarantee. It helps us anticipate potential scenarios and react accordingly. Let's go back to 1998. Look at this chart. This is the pattern we need to be aware of. 2 waves down, then a rally. The challenge is determining if that rally is sustainable or if it's simply a dead cat bounce. You see, the 50-day moving average was right there, acting as resistance. The market ran out of steam. It's important to lean on that 21-day moving average, but be ready to pull back if the rally falters. Let's look at September 2000. Similar situation. A rally after a decline, but ultimately it wasn't enough. That's where the importance of patience and disciplined trading comes in. In 2008, we saw a similar pattern. A rally that stalled near the 200-day moving average. And then the most recent example, the COVID crash of 2020. That one ended differently, with a sustained breakout. But the lesson remains the same. Each scenario is unique, but the underlying principles of technical analysis remain constant. What we're looking for are signs of confirmation. Like a low consistently above the 21-day moving average, closing higher and higher. That's a signal of strengthening momentum. And when we get to the 200-day, that's when we need to dial back our exposure, be prepared for a potential whipsaw. It's not about predicting the future, it's about being prepared for anything. Now let's look at the ETF action. What sectors are leading the charge and which are lagging behind? Materials are weak, industrials are also showing weakness. Utilities and staples are defensive, and we're actually seeing money rotate out of those sectors, which is a positive sign. We want to see capital flowing into riskier, growth-oriented areas. Technology is showing some relative strength, but it's not uniform. Communication services are holding up, driven by the mega-cap tech giants. But we need to dig deeper, look beneath the surface. That brings us to some individual stocks that are showing promising relative strength. Mercado Libre, breaking out of a double bottom pattern. Spotify also exhibiting strength, but with earnings on the horizon, so caution is advised. And then there's PLTR, a true standout. Up 20% this week. This stock is behaving differently than many others, suggesting underlying strength. PLTR is a high-octane name. It moves quickly and it demands respect. But the technicals are compelling. It's above its key moving averages. Its relative strength line is in positive territory. It's a leader, and in a market like this, leaders are what we want to focus on. But remember, even leaders can stumble. That's why risk management is paramount. Define your edge. What makes this trade worthwhile? What's your plan if it goes wrong? And write it down. Seriously. Document your rationale, your stop-loss levels, your profit targets. It's a simple exercise, but it can save you from making emotional decisions. I've gotten into the habit of emailing myself my trade plan. It creates accountability. It forces me to think through the risks and rewards. And it provides a valuable record for future analysis. We're at a critical juncture. The market has shown strength this week, but the path forward is still uncertain. We're navigating a complex landscape, and we need to be prepared for anything. Stay disciplined, stay focused, and remember that the market doesn't owe us anything. We have to earn our returns. Now, let's turn to our song of the week. Webby, what have you got for us? I've been thinking about it all week. And I'm going with the Ramones' Blitzkrieg Bop. Hey ho, let's go. It feels like a week where you just want to charge forward. I'm going with something a little more bluesy. B.B. King, Better Not Look Down. A reminder to stay focused on the present, to not dwell on past mistakes or future anxieties. It's a good mantra for navigating this market. And with that, we'll wrap things up for this week. Thank you for joining us. If you want to stay up to date on our team's thinking, be sure to check out IBD Live, our daily show that starts 10 minutes before the opening bell. And don't forget about our monthly screen trader updates. We appreciate your trust and your engagement. Remember, investing is a journey, not a destination. There will be ups and downs, twists and turns. But by staying informed, disciplined, and grounded in sound principles, you can navigate the market with confidence. Until next time, take care and happy trading.